thank you so much for joining us today as we cover this big and highly politicized topic, the One Big Beautiful Bill Act, or the OBBBA for short. Not that short, but anyways, today we're going to focus on the facts and the planning implications. We're going to try to leave the politics behind. So with me today, I have my friends and colleagues, Brandon and Matt. And so Brandon, I'll start with you. So how did you vote in the 2024 election?
Thanks for that, Blake. Yeah, that's nice. Put me on the spot. I'm guessing Matt put you up to that. Thanks. With that wonderful introduction, so I'm the head of financial planning here at Composition, and as Blake said, we're really going to be focusing on not every aspect of the bill. What did we figure out? It's over 1,000 pages. So we're really going to try and focus on what affects our clients. And so with that, Matt, I'll let you introduce yourself.
Yeah, thanks, Brandon. Thanks, Blake. So I'm Matt Dimitroshin, the Chief Investment Officer at Composition Wealth. Obviously, a lot in this bill, most of it impacting kind of the planning side of things. I think a lot of interesting things there, but some interesting things on some of the investment side, as well as some thoughts around how the bill may impact the economy for the good and the bad.
All right. Thanks, guys. All right, so let's get down to business here. So as we begin, right, on the 4th of July, Trump signed into law his crowning achievement thus far, delivering on a number of his campaign promises, definitely providing the fireworks of a show of a different kind, really. You know, I, along with other people in the general public and even some lawmakers, were really shocked at how fast this all came together. Whether you see this as a legislative genius or political genius, or whatever your view is, the law has shaken up nearly every corner of investment, financial, and estate planning. So from the so-called permanent estate tax exemption to some quirky new income tax rules and phase-outs, this law gives us and leaves us with plenty to dissect and to plan around. You know, the bill itself, as Brandon kind of mentioned, is 1,038 pages long with lots and lots of fine print. You know, many of us know the headlines, right? The continuation of the tax rates and tax brackets and permanent estate tax exemption law. But today, we want to dive a little deeper. As our presentation is titled, Beyond the Headlines, we're going to dive a little deeper on a few aspects of the law. Now, unfortunately, at this point, we only have the law itself, right? It's less than a month old, and practitioners, and we're just all trying to get familiarized with all the ins and outs. But unfortunately, we're not going to have a lot of help. Normally, when a big law like this passes, the IRS jumps in and gets the work, and they come in and interpret some of the provisions and provide guidance to the public. Unfortunately, the IRS is down about 25,000 individuals since May. And so we're expecting this to be a lot more ad hoc, as a lot more people from the public, like us, are going to be tasked with presenting and explaining these concepts to the general public. So, as we go through the presentation here today, please feel free to send us questions in the Q&A chat box, and we will weave those in as we are going through the presentation. But we might have to come back and circle back to some of them afterwards. And quite frankly, some questions you might ask, we might not know the answers to as of yet. As I said, this is all a work in progress as we're interpreting the law, among with many other practitioners along the way. So thank you again. Today is another way that we're trying to deliver on all aspects of our promise to our clients, to be more than just the average advisor and touch all aspects of our clients' lives. So the agenda that we're going to hit on today, we're first going to start off, and Brandon is going to talk about how the financial planning world has been reshaped a little bit. Then we'll hand off over to Matt, and he's going to talk about some investment planning in the post OBBBA world. And again, you're going to see that a lot, OBBBA. And then I'll wrap it up and talk about estate planning and the new environment that we all are adjusting to. So with that, Brandon, I'm going to hand it over to you as you talk about the financial planning aspects of the new bill.
Yeah, thanks a lot, Blake. And I just wanted to emphasize what he said about, what might change and what is still a little bit uncertain. Something that we discussed internally, whether or not we'd bring up today, were the Trump accounts. And not because it's not a great planning opportunity or a not so great planning opportunity. It's more, we just need to know a little bit more. I mean, one of the main things we don't know is how and when you can open it. I mean, some estimates are, hey, it won't be fully formed until 2026. There'll be aspects of it that are retroactive, but we don't want to bring that to you until we can say definitively, hey, this is a good idea. I think you should incorporate it for, children born after a certain date. So still feel free to ask those questions if you have them. We'll do our best to answer them. One of the things that is at least fairly clear is the 529 changes. They're getting a boost, right? This has been a great tool for years. Many of our clients take advantage of it, and we encourage many of our clients to take advantage of it. And one of the things that's passed in recent years is the ability to use a 529 for pre-college expenses, so K to 12. And that had been limited in both scope and amount to $10,000. So that, with the new bill, has increased to $20,000, is certainly a welcome change for those of you that might have some expensive private school bills going on. It also expanded the qualified expenses to tutors. So, if you need that little extra help in math for Johnny or Jimmy, you can now use a 529 for that expense as well. So same with standardized testing costs, whether this is the actual test itself, whether it's for a tutor for that test, for testing materials, you can now dip into 529 for that. And then also educational therapy costs for qualified students. So we're really just seeing more and more expansions of how 529 can be used. And just a reminder, a few years ago, we also expanded the ability to convert part of a 529 to a Roth account. So we won't cover all that today, but just, as you can see, this continues to expand and is really valuable for our clients. Another thing, qualified expenses for professional credentials. This is really interesting. It's, let's say that you're a college graduate and your parents had a 529 for you, or your grandparents had a 529 for you. You didn't spend all the money. And now you're a CFP, or you have your law degree like Blake, or you have your CFA like Matt. We have continuing education expenses. To maintain those credentials in our industry, we have to continue our education. Sometimes that costs money. And so if one of us had one of those, we could dip into it and cover those annual expenses.
Wow, Brandon, that's big. That's a big change. So you're saying there's no age requirements. It's just, hey, if you can access a 529 for these expenses, right?
Exactly. And that's, I won't make a blanket statement because again, they're kind of fine tuning and everybody's trying to figure out exactly what qualifies as a post-secondary credential program. But as it stands today, it's pretty broad. And that's extremely valuable because also from an examination standpoint, it can be pretty expensive. CFA, it's 3 exams. And there are different materials for each exam. So you can really add a lot of value by having a little extra in that 529. So it's not just sitting around. So the next thing, and this actually is in the headlines, but we want to dig in a little deeper and try to identify the specifics around a few of these deductions, but then also the planning opportunities. I think that's the reason a number of you are here, maybe, obviously for Blake and Matt, but also for how these deductions are going to affect your financial plan. So the three we want to cover are the $6,000 senior deduction, the SALT deduction, and charitable deductions. That fourth one is an interesting little wrinkle that we'll explain further in detail in just a bit, but it's an itemized deduction limit. So we'll start with the $6,000 senior deduction. And what I want to point out here is this is when people are saying Social Security is no longer taxable, this is what they're pointing to. And I just wanted to be clear that Social Security is still taxable. The point that some of those articles were making is that far fewer seniors would likely pay tax on Social Security with this deduction in place, but it does not eliminate tax on Social Security. So, when you're working with us, we're going through tax projections. We can show you how this affects Social Security, how it affects your total taxable income each year. But again, it just doesn't eliminate that tax. So, real quick before we go to SALT, it's available for 65 and older. And the thing that we're looking at and we're planning for with clients are those last two bullets, right? Is where are the phase outs? Excuse me. Because it doesn't apply to everyone. If you make $500,000, you don't get this. And if you're married filing jointly, you don't get 6,000. Of course, you get 12. So we may want to be strategic about how we are, recognizing income to make sure that you do get this if it's, valuable for your plan, and also that it expires in 2028. We're going to talk about permanence, like to use your air quotes, permanence versus expiry. And it's important, but at the same time, there's an asterisk, right? Because somebody can come in and change that. They can make something that was permanent, not permanent, and they can make something that expires or set to expire extended. I mean, just look at the Tax Cut and Jobs Act. A lot was extended. So keep that in mind. And then we'll talk about the SALT deduction. This is a big one. Become a political bargaining chip, right? Is it 10,000? Is it 20,000? Is it 40,000? Is it uncapped? Are there phase outs? That was a big back and forth between the House. Landed was an increase to $40,000 a year. So we're especially looking at those of you in high tax states, New York, California, Washington. If you have a substantial state and local taxes, this could be valuable for you. But we do also want to keep the phase outs in mind. And we are, again, with a grain of salt, considering the expiration in 2030.
Hey, so Brandon, real quick, the phase out. So it starts at 40. Does it go to 0 after the phase out, or does it land somewhere? Or how does that work?
Yeah, great question. So it comes back down, at least from what we're seeing now, down to 10.
Okay. Good.
So for charitable deductions, so only contributions exceeding 0.5% of AGI can be itemized. What does that mean? So you multiply 0.5% by whatever your AGI is, and you need to have charitable contributions that exceed what we would call that floor. Anything below that isn't even going to be counted for charitable deductions. So that's something to keep in mind, especially for those that are more charitably inclined. And then this is the non-itemizers can now deduct, and this is again permanent, deduct cash contributions to qualified charities. So even if you're using the standard deduction, if you're filing jointly, you can use $2,000. If you're filing single, you can use 1,000. So, and then the itemized deduction limit. So total itemized deductions are capped at 35% for those in the 37% tax bracket. What does that mean? It just means that if you are a high earner, you have a lot of adjusted gross income, and you land in the 37% bracket, the takeaway here should be that deductions aren't going to be quite as valuable as they were in years past because they're capped at 35%. So taking all of that into consideration, what are some of the planning opportunities? And I do want to note one thing, and Blake, hopefully this isn't stealing your thunder, is there's a good chance we come back to you all in September with a more fully formed planning opportunities presentation as we get clarity and as we get certainty around what some of these provisions are. But what we know,
quite frankly, maybe we do, hey, here's what we need to do in 2025 while we still have the old tax law before the new tax law comes in. So yeah, I could see a lot of topics we could cover.
Yeah, and it's a great point. It's teeing us up well. So, Roth conversions, for those that have worked with us for a while, you've probably heard that. Even if you haven't, you've probably heard that. It's a powerful tool for some. Oftentimes we find a way to make these valuable, but that's not always the case. So as we talk about these things, we're always going to frame it in, does it make sense for client A? Does it make sense for client B? We're never going to be sort of wholesale prescriptive, but that's something that's on our plate. Increased capital gain recognition. So let's say you've been trying to diversify that position in Apple because your basis is so low and your capital gains are just astronomical. At some point we want to help you diversify. Maybe we accelerate that program given where tax rates are, given what deductions are available. Or, you could reset basis. And then, along those same lines, you're going to see a lot of these opportunities kind of tie together. You can almost think of them as different levers that we're going to pull. So find ways to increase or accelerate itemized deductions while increased SALT is in effect. And then, along those lines, it looks like part of that got cut off, but larger donor advised contributions in 2025. To Blake's point earlier, maybe there's an opportunity to take advantage of something that is going to expire at the end of this year. So that's something we'll bring to you as well.
Brandon, I think you make some good points there in that, what we have this interesting environment where some things don't take effect till 26, some expire and sunset in 28, some sunset in 2030, some are permanent, but we really question whether they're going to be permanent if you get a new administration in. And it really kind of plans, so you almost need to start thinking about your situation in a multi-year period. Maybe that increased capital gains. I know I've got 3 years where maybe the tax code is in my favor. I don't know what's going to happen after that. I want to start thinking through that. So I think some very good points you made there.
Yeah, and just to add to that, Matt, I'm glad you bring that up because oftentimes we're looking to the future, but also there's a burden the hand mentality oftentimes here too. So yeah, thank you. AMT, I'm going to keep this as simple as possible. AMT is confusing. AMT is, we study it even as advisors. I think even as a CPA will admit this is confusing. But what we want to do is just kind of identify the individuals that should just be on higher alert that, hey, AMT may affect you, reach out to us. We'll do a tax projection. We'll go through your return. We'll go through what your expected income is. We'll help identify if you need to plan around this. So those with large SALT deductions or incentive stock options. So that's one group of people. So joint filers with taxable incomes between 300 and 500,000 definitely want to keep an eye out for this. And then single filers between 500 and 676,000, and then joint filers between $1 million and $1.2 million. Oftentimes they're probably already subject to AMT. But what's going on with this new bill is they're likely going to be in an even higher sort of AMT space, if you will. And the reason behind that is the exemption amounts and phase out levels have been changed. So again, I'm not going to get into all the nuts and bolts there. We'd start seeing our attendance just plummet. But keep that in mind. If you fall into one of those sort of buckets, if you will, reach out. We'll go through this and we'll help you through it. And another piece of legislation here that doesn't affect a ton of people, but for those that it does, it's extraordinarily valuable. So qualified small business stock has been valuable for a long period of time. And there are specific parameters that qualify what we call QSBS, which is, a webinar for another time. But for those that know they have it or know that they will have it, the exclusion for newly issued QSBS is jumping to $15 million. So we're talking about $15 million worth of capital gains that you pay no tax on. So while this affects a small group of people, it is so impactful that it's worth mentioning. Even if it's one person on this call, we need to talk about it, and we need to make sure that you get to take full advantage of it. And then the last,
real quick, if I have a company that I formed a while ago, I don't get to take full advantage of 15 million. I only get the 10 million. Is that what you're trying to say? Is newly issued going forward?
Yeah, exactly. So it's not retroactive, but the 10 million is still not bad. But for the 15 million, it needs to be after July 4th. Good question. So I think, that does do it for me. I'll pass it over to Matt, and he's going to talk about some investments and how they relate to the OBBBA.
Yeah, thanks, Brandon. So if you actually go back to the Tax Cut and Jobs Act, so the 2017 legislation that happened under the first Trump administration, one of the big pieces that came out of that was this concept of an opportunity zone. So an opportunity zone is really a census tract or a tract of land that is kind of considered low income and in need of development. So it could be a tract of land in an area that has a 20% poverty rate. It could be an area where the average income is 80% below the median income. And so that there's a number of these tracts. Governors then can pick up to 25% of those tracts of lands and designate them as an opportunity zone. And so back to the Tax Cuts and Jobs Act, the whole impetus was let's spur reinvestment and investment in these areas. How can we do that? Well, what if we encourage people to defer capital gains, get some tax benefit? They can do that through investments in real estate. So buy a piece of land and put an apartment building up there. Or they can invest in a business. In a small business, it's very narrowly defined. The business has to be located in that opportunity zone. They have to generate 50% of their revenue in their opportunity zone. Hard to find those, harder to invest in those. And so what ended up being is about 75% of the investments to date in opportunity zones have been more in real estate. So the focus will be kind of, our comments will be more tied to the legislation and a little bit more on the real estate side of things. And so the benefit to somebody investing in this is that they're really allowed to defer the payment of taxes on some capital gains from the business I just sold or a stock that I just sold. And on top of that is if I hold that investment for, we'll call it a 10-year period, I actually get tax exempt depreciation. So it's helpful if we kind of walk through the old legislation and then talk about how that's kind of been renewed in the new OBBBA bill. So under the Tax Cuts and Jobs Care Act, so that passed in 2017, the way it kind of would work is in 2018, let's say I had a business that I sold for $5 million. I'd purchased the business for $2 million. That means I had a gain of $3 million. Within 180 days of selling my business, if I put that $3 million in an opportunity zone fund, so maybe that fund was buying, 3 different properties across 3 different opportunity zones, or maybe it was tied to just, hey, we're going to build a new manufacturing facility in one opportunity zone, I'd make that investment. 5 years later, so call it 2023, I would actually get a 10% step up in basis. Well, I don't have any cost basis initially because I just rolled $3 million worth of capital gains in that had zero basis. But now by holding it for 5 years, I get 10% step up. So now I have a basis of $300,000. The late legislation then said, hey, by 2025, so this year, I can get an incremental 5% step up in basis. So now I've got 15% or $450,000 of my initial $3 million investment that's now a basis, that now has a cost basis. Fast forward to December 31st of 2026, so the end of next year, taxes are due on that capital gain that I had way back in 2018 that I'm deferring. And the way that works is now that I actually have $450,000 worth of basis, I now only owe capital gains on 2.55 million instead of the full 3 million. So I owe a little less tax because I have a little less of a gain. The big benefit being I got to defer paying that gain for 8 years. Then the last piece of it is, let's say after 10 years, so you need to hold it for 10 years, you get to the end of 2028 and that property gets sold. It's been developed, that apartment complex has been sold, and my portion of that is now worth $5 million. I get to get tax-free appreciation in that. So now I get to take that full 5 million and it's tax-free to me. So that 2 million of incremental gain, I don't have to pay taxes on. So it was a nice way to encourage investments in some of these lower income communities and to help develop them, but also provided some nice tax benefits. So now if we fast forward to the OBBBA and the changes. So first, the initial opportunity zone legislation from the Tax Cuts and Jobs Act, that was just kind of a one-time thing. This now becomes permanent. And so the terms are now going to be set up more for a permanent structure. The second, I think in hindsight, when you look back, when those opportunity zones were structured and they picked the exact geography, it could have been a plot of an area of land that was largely lower income, but it could have had a little bit that was maybe a higher income area. And so we actually saw this. We saw some opportunity zone projects. You look at that and you were like, really, that area is considered an opportunity zone. I think learning from that, the new legislation is going to have more stringent criteria on exactly how that opportunity zone is going to be defined. So trying to make version 2.0 a little bit better than 1.0. That same structure is going to be in place. So you're going to have that 5-year deferral of capital gains and with a 10% step up in basis in those 5 years. And it's going to, the new legislation wants you to hold that asset for at least 10 years. But if you meet that threshold, you get that tax-free asset appreciation of the investment. So following the similar logic that was put in the first version. One add-on area is they're actually including rural opportunity zones. So populations less than $50,000. There you're going to get a greater step up in basis of $30,000. A lot to kind of unpack there and a lot of kind of work to kind of flush out. So as Blake and Brandon mentioned, there's still a lot of work to do in kind of flushing out exactly how this unfolds, but that's a new area. And then I think it is important to note that the opportunity zone legislation, because the first version doesn't really sunset or the tax payments aren't due until the end of 2026, the opportunity zones 2.0 under OBBBA don't really start until January 1st of 2027. So it's kind of a way of kind of extending what was kind of an attractive tax management feature for clients and for investors, but also a way to kind of incent investment in lower income communities.
So, I mean, with this, Matt, though, what's interesting is, is it purely a tax play here, or is there actually an investment merit? Like, are there good investments here?
Yeah, it's a good question. It's been kind of mixed. So the challenge you have is if you're investing in an area that you want to develop, you want to improve upon. So, what we've seen is some investments haven't worked out. The area has changed, the demographics have changed, maybe the income around it doesn't support the project. But we've also seen other areas where it's really helped to re-gentrify the community. And so this is, while the tax benefits are very attractive, investment selection is very important, because if the project doesn't work, you might not be caring about whether that you get the tax-free asset appreciation. And so we actually like having some diversification here. So investing in either opportunity zone funds that have multiple properties to them, or spreading out that capital gain to multiple different opportunity zones where you can get some diversification in some of these assets. So it's real estate. At the end of the day, location, location, location. And some of those locations work, some don't. It's a great question. It's not purely just a tax play.
Hey, and Matt, before we move to a different topic, one thing I'm interested about, since this new legislation doesn't take effect until 2027, do you think that people are just going to defer until then, or they're going to find other? We apply the old law until then, or what do you think's going to go on here?
Yeah, that's a great point.
Loaded question. I'm sorry.
Well, so under the legislation, as it stands, you have 180 days after you sell an asset and realize that capital gain to put it into an opportunity zone. So if I sell my business today, I can't wait until January 1st of 2027. So I can go into one of the old opportunity zone funds, which is better than nothing, but now I really only get to defer that capital gain until December 31st of 2026. So I think there'll still be demand for those types of projects, but it's not going to be as great. They're not as fresh of projects. I think it's really going to depend on when that capital gain realization is.
Thank you.
So the other area I think to talk about is just broader. What is the economic ramifications? Should I be concerned about the OBBA? And I would say, bigger picture, separate, longer conversation. And we've written and talked a lot about the tariff side of things. I mean, we do think that moderates economic growth in 2025. But one of the benefits, I think, of the OBBA from just a pure economic standpoint is it does have a stimulative impact. So when you look at, and Brandon did a great job of kind of couching, it's not like Social Security is tax-free, but there are tax deductions around Social Security for those that qualify. There's, tax-free on tip income. There's tax-free on overtime income. So you now have improved tax benefits that are going to put more money in consumers' pockets, and that's going to be stimulative to the economy. It's not going to be excessive. So if you actually look at the Committee for Responsible Budget kind of estimates, it's about 500 to 600 billion worth of impact over the 3-year period between 2026 and 2028. So, simple math of about 200 billion a year. The Tax Foundation kind of looked at a bunch of different projections, could be the CBO, could be others. And they kind of range from saying it has about a 0.1% impairment to the economy to as much as a 1% per year benefit to the economy over 10 years. So we look at that and kind of say, depending on what you want to factor in and how stimulative it is and how the debt finance is financed and at what rates, that probably has a modest, moderate impact to the economy. Where I actually see there being a bigger benefit is on the bonus depreciation and R&D expensing. So the bonus depreciation, the OBBA, is going to allow any sort of property or capital investments to be fully depreciated in the year it was purchased. So if I decide to retrofit my factory with all new machines, and I do that in all of 2026, I can take that entire cost and get that and depreciate in the first year instead of depreciating it over 3 or 5 years. And so that may spur companies to start to spend and invest in new facilities, new capital equipment, and the like. That could have a nice stimulative impact to the economy. Similar on the research and development side, the way the tax code was previously written is you'd really kind of amortize those costs over 15 years or spread them out over 15 years. Now you can take it in the first year when you spend it. It's going to encourage some accelerated R&D investment. So it actually leaves us more optimistic as you get into 2026 that there could be this pent-up demand just purely from some of the tax benefits from companies reinvesting in themselves through the OBBA language. So we kind of leaves us more cautious, I would say, in 2025 as we see the tariffs just having to moderate the economy. But then we actually think this may accelerate the economy a little bit as we get into 2026 and companies start to spend.
Hey, Matt, and take this as a grain of salt. You don't need to take investment advice from an attorney, right? But I'm from the Midwest. If I had my druthers, I'd be investing in like John Deere and pickup truck manufacturers, because you're going to see a lot of new equipment out there on the roads and in the fields. So
yes,
take that with a grain of salt, like I said. All right. Well, okay. Well, thank you. And I'm sure this is what everyone tuned in for, is estate planning in the new tax environment. Now, it is a new era, right? But for how long, we don't know. So the act created long-awaited stability in the federal estate tax law. So we've set I'm going to do it again, permanent estate tax exemption at $15 million per person, indexed for inflation. Now it maintains portability, estate tax portability. It means if I die, leave everything to my wife, she can use my exemption in her death. So it's portable. The top tax rate stays the same at 40%. And the concept of step up in basis is maintained as well, right? I buy a stock for $10 a share. At my death, it's worth $1,000 a share. My heirs will inherit that at the fair market value. The basis will step up to the fair market value at death. So as you see, with a higher exemption, with basis stepped up and portability, we might have some different things to think about. Well, first I want to talk about this, the federal estate tax over time, right? The federal estate tax started in 1916. Well, it was around a little bit before. It was called a stamp tax, but the idea is we created it in the form that we know now as a way to fund World War II, or World War I, excuse me. Again, we ramped it up for World War II. It's interesting. You look at this chart. Well, geez, near 80%, near a large swath of the time here in the country, in the 40s, all the way up until the 70s. I think about the harkening back. We're harkening back to the 1950s. Well, we're definitely not going to the 1950s tax rate. That's for darn sure. But here's what I want to talk about a little bit: is the exemptions over time. Now, what we have right now, as I said, it's a $15 million exemption. That's the amount you can pass at your death free of tax. Now, let's go back a little bit. Before Trump's first Tax Cuts and Jobs Act in 2017, the exemption was just over 5.4 million. At that time, only 0.14% of Americans who died owed an estate tax. So we talk about the 1%ers. Well, it was a fraction of 1%. 99.86% of the population was not subject to estate tax. 99.86. And now we go and fast forward to 2026, and now we're projecting less than 0.05% of the population will be experiencing estate tax. So that means over 99.95% of the population will not be subject to any estate tax. Show of hands there in the audience, or does that surprise you? Right? This is always one of the mainstays of, hey, we're going to talk about this, the estate tax. We don't pay estate tax, but it is surprising when you finally put it in perspective of, oh, okay, this doesn't really apply that broadly. For those that it does, absolutely. There's planning ways that we can get around a lot of this, but very interesting to note that along the way. With these high exemptions, estate planning still matters. We might not be doing estate tax planning as we might have, but estate planning still matters. And why? Well, it's because of control. The assets that we have, we want them to go to who we want, when we want, and how we want. Right? An 18-year-old does not need to inherit a bunch of cash and go and blow it. And how are we going to make things better for my family, for my heirs, generationally? So the focus now might be shifting by some of these old structures. Maybe we're now, instead of estate tax, we're talking about income tax efficiency. And maybe we're going to shift in that upper echelon. Maybe we'll talk more about asset protection and not necessarily, again, estate planning for estate tax purposes. Now, permanent. Don't mistake permanent for certain. History shows that permanent tax laws are often revisited by future Congress. And fiscal pressures may prompt future change. And what's the pressure? Well, our debt is about 37 billion, or trillion with a T, trillion dollars today. Now, the bipartisan scores of the bill said that the OBBBA will add another 3.4 trillion to the deficit over the next 10 years. Don't want to be political about it, but I just want to bring people to the reality that, yeah, hey, permanent means permanent as long as the party that's in power stays in power, because it could change dramatically afterwards. So flexibility, and we've been talking about this, and that's the picture here, flexibility. I can't even touch my toes, but I'm like that person there. The idea is making our plans more flexible, adding in powers of appointment, trust protectors, modification clauses, and things like that to make it as flexible as possible.
But can you speak more about that? The powers of appointment, trust protectors. I mean, they're not your everyday terms, so it'd be great to hear a little bit more.
Yeah, absolutely. And you know, we go back to I think about why these are important to going forward. The traditional plan, you know, the one that was drafted 10 years ago, right, would say, hey, at the first bout for the surviving death, whatever's in that trust is not includable in the surviving spouse's estate, which means that the assets in there do not get a further step up in basis. Now, it doesn't matter if we're going to pass about the same period of time, but I always think about my grandmother. My grandfather died in 1968. My grandmother died in 2015, right? If we had that type, we didn't have any wealth. But if that kind of thing was set, things in that trust over that time period, when my grandfather died, they could have been locked up for 50 years without any ability to change or modify them based on current circumstances or tax laws and the like. And so that's what these things are designed to do. Powers of appointment are designed to provide the beneficiary flexibility to say ultimately where those assets may end up. Trust protectors may be able to grant a different type of ability for the person, the beneficiary, to actually include some of those assets in their estate to get a step up in basis because the state tax exemptions are so high. So there might be different things like this that we want to make sure are built into these plans because, hey, we think we got a permanent law, so let's plan accordingly. But let's be flexible because it might not always be, and we might revert back to what we had before. So thanks for that question, and it really opens up a new can of worms there. So along those lines, same message, is rethinking our current plans and rebuilding. Look at modernizing some of these structures. Again, with the idea of flexibility, we might revert back, but why not simplify things? And then we think about this too, right? Why not find ways to maximize basis? If we can make sure that, hey, the stock that I bought today is going to be able to get a step up at my death, and then again when my wife dies, that's the type of thing we need to be looking at. And the increased exemptions allow us the opportunity to do that. Again, it might be going back and doing major renovations on our estate plans. And then some of these structures, we might look at how we can look at redo them as well, right? Because we might have a family business that says, hey, at death, we're going to let my kid buy at a discounted value, right? Well, maybe we shift that, because whatever I purchase something at, that's going to set my basis in the asset. So when I sell it down the road, I'm going to have a large tax at that time. So we might look at simplifying some of these things, maybe doing things a little bit more differently at death and the like. And also think of reevaluating the goals. A generation skipping tax exemption is married to the estate tax exemption, but oftentimes to utilize those types of provisions, that means that we're keeping things in trust. They're going to avoid taxation at the next generation a lot on down the road, and potentially forever if you use a South Dakota trust or a Nevada trust, or 365 years for Nevada. But what we might want to do, again, it goes back to that whole basis adjustment. We might not want to let things stay in trust forever because the basis gets locked in that case. We might want at some point to have a state inclusion, get a basis adjustment, making Matt's job a lot easier because, hey, if the basis is high, he can buy and sell and diversify a portfolio pretty easy without tax consequences along the way. So a lot of maybe renovations are going to be happening going forward. Now, one of the big things and Brandon talked about is SALT, state and local income tax, right? Income tax planning is going to be more important than estate planning for the 99%, actually 99.95% of the population, right? And so we might be able to find ways to stack SALT deduction. So it's 40,000 up to, but of course there's phase outs up to a certain amount. Well, maybe you create a non-grantor trust in another jurisdiction to allow that trust to also have a $40,000 exemption. So you get your personal exemption, the trust can have its own exemption. You can multiply this and stack it along the way. Of course, what might actually happen more is we use those types of trusts not to stack SALT, but maybe to keep us qualified for that 40,000. As Brandon said, that phase out, the $500,000 to $600,000 of income, you go from $40,000 to $10,000 pretty quick. And so maybe we find a way to create a trust in a different jurisdiction that we run some of the income through there. That way it doesn't impact me. I still am below the 500,000. I can use my 40,000 of deductions, and the other is sheltered somewhere else entirely along the way. So again, might be some things to do there in some of these unique trust structures and the like. But at the end of the day, yes, estate taxes at the federal level not going to impact a lot of families, but at the state level they may. And so we can't ignore state estate taxes. So take all that with a grain of salt, right? That makes sense. We're talking about salt, but still, it's federal level, it's state level, and prioritizing where we can for the maximum impact for your family, friends, and everybody that's important in your life. So.
Blake, you mentioned the state side, just confirming what happened with OBBBA didn't at all impact anything with state taxes.
Yep, exactly. Every state is free to tax their citizens as they like. So for now. Okay, well, there is a plethora of things that I'm happy to talk and discover with you and your family. We've got a lot of tools in the toolbox. The uses for a lot of these is not for everybody, but definitely some things along the way we can talk about with the shifting dynamics, with the shifting of your family and your circumstances. We can talk about these strategies in today's environment, how they might make sense for you and your family. Now, there's a lot of other aspects of the OBBBA that we have not talked about, and we, never said we're going to talk about everything. There's a lot of changes out there, and maybe some of these things we'll bring up later. But yeah, big changes for the Trump accounts, as Brandon said. The no tax on tips, overtimes, auto loans, things like that. A lot of fine print there. A lot of fine print that, again, we didn't want to cover that here today. QSBS, we talked about that, but there's a little different on the deductions for individuals with LLCs, flow through taxation and things like that. We didn't talk, and we don't have time to talk about that. Child tax credit enhancements and changes the subsidies for the Affordable Care Act, which are going to impact a lot more people than we think. So more to come. So tune in for we're going to we'll put it out there. We're going to come back to it and talk. We'll do a second webinar on this topic, maybe a third and fourth. Who knows? But we do have one that's scheduled here in the near future. Our very own Samantha is going to be talking about suddenly single, planning around life's largest and biggest transitions. That's going to be in September. So put that on your calendar. Tune in for that, and we'll be glad to be a resource for you. So again.
Maybe to highlight to Blake, we do kind of store these webinars if you wanted to re-listen to this or go back and listen to some other great things that Blake and Brandon have said in the past. Those are on our website under the webinars and events page. And also the YouTube channel, which I recommend for great evening watching.
Hey, very good. All right. Well,
I do.
thank you, everyone. Do we have any questions that have popped up along the way?
Yeah, so just there were a couple. I think Matt and Blake, you answered one on state estate tax, which is great. But there a really good question came in about qualified charitable distributions from IRAs. Someone asked whether the 0.5% AGI floor is going to affect those. No. So the distributions that the IRS allows you to give directly to charity from an IRA or qualified account, again, directly to charity, when you're age 70 and a half or older, basically tax-free, that's still in effect. That's unchanged. It's completely different, and it's a great strategy that we'd love to talk to the more charitably inclined about once they reach a certain age.
All right. Well, thank you everyone for joining us today. Stay tuned. There'll be more. We're even going to put out probably a white paper or so after today, just for more information, and stay tuned. This is one of many. So appreciate it. Have a great day, everyone.
Thanks everyone.